Alright guys, let's quickly revise investment decisions once better. I said investment decisions chapter beta is also known as capital budgeting, meaning better that here we are trying to check if you are supposed to make investment in a project or not. Okay, budgeting for your capital investments is what is meant by your capital budgeting. These decisions I told you beta are important because the amount of expenditure involved is significantly higher as such guys. They are irreversible as such guys. And the benefits accrue over a very long period, and there's too much of contingency guys, as in we do not have any control over the cash flows that are going to arise on a later date. On the basis of, so these capital budgeting decisions which are broadly segregated into two categories guys. One is on the basis of firm's existence, the other one is on the basis of situation. On the basis of firm's existence, what I told you, it can be an expansion decision guys, it can be a expansion guys. The next one beta is replacement decision guys, or a modernization decision. Expansion में क्या होता है? Diversification भी है. Expansion में क्या होता है बेटा? You are only increasing the machining capabilities as such guys. Replacement, that we saw in a lot of questions, you're replacing one asset with an other asset. Diversification, getting into a new line of business. On the basis of situation guys, I said this mutually exclusive. Mutually exclusive का मतलब क्या? There are multiple projects as such guys, but you can select only one. Then there is accept reject. There's only one alternative available. You're evaluating whether you have to take it up or not. Then beta I also spoke about contingent decisions. Investment in one asset beta may lead to an investment in an other asset. Irrespective of the type of decision guys, the first important factor that I told you to remember in this entire chapter is that decision making is always from the viewpoint of the entire firm. That is why we take cash flows available to all the providers of capital, and we take overall cost of capital beta as a discounting factor. Meaning, even if they give us details regarding debt or interest payments or dividend payments, we cannot consider them as outflows. You have to compute only cash flows from the viewpoint of the firm. So all of these payments cannot be considered. KO beta will be weighted average cost of capital of all the sources of funds collectively, जो भी अपन raise कर रहे हैं. Next guys, decisions beta should always be based on cash flows, not on the basis of profits. You never take profit beta because profits cannot be reinvested. If you want to know whether you've actually recovered your investment or not guys, you should be able to generate reinvestment income on that. So timing of cash flow is important as such beta, rather than the time in which you're recording the profit in your books of accounts. Decisions are always based on incremental cash flows, not on the basis of totality. This is specifically very important for a replacement decision. You always compare guys, what is the amount of cash flow that you're generating with the new asset, without the new asset, and then see what is the total incremental amount. Next guys, I told you, in case you have any sunk cost as such guys, it is never relevant for decision making. Because the cost is already incurred guys, whether or not you include it as such guys, the decision is not supposed to change. Of course, objective beta will be to recover all sunk cost also, but even if you do not recover it as such guys, you should still go ahead with the project. Apportioned overheads guys, I said, are not relevant for decision making because the total amount that you're incurring guys will remain same with or without the project. Because the total amount remains constant guys, again apportioned overhead should not be considered. Any opportunity cost as such guys is always relevant for decision making. We've seen that in a couple of questions better, that in case you accept a project, you will not be able to lease out your factory and you will have to forego your rental income. I said take that as opportunity cost. Or in case you decide to use the existing asset for 1 year, 2 years guys, you'll have to forego the existing salvage value, which again should be considered as opportunity cost. Alright guys. In order to depreciation is a non-cash item as such beta, it is not relevant for decision making. However, depreciation will still result in tax savings. That is the reason guys, to arrive at the correct amount of taxes, I said you start with profit before depreciation and taxes. You deduct depreciation, you deduct taxes, and then you add back. If at all they use the word cash flow before tax, that means it is profit before depreciation and before taxes. If they use the word cash flow after tax, that is the end result. If they use the word profit before depreciation but after taxes, CFAT. Profit before depreciation matlab cash flow after tax. Are we clear about this? Now after this beta, we moved on to capital budgeting. We divide our cash flows into 3 categories beta. We have interim cash flows, periodical cash flows, and terminal cash flows. Every single cash flow here should be on an incremental basis. Let that be initial, let that be periodical, or let that be terminal cash flow. Now your overall capital budgeting techniques as such beta are segregated into 2 categories. One where time value component is considered, the other where time value component beta is not considered. Under the first head, beta, we have accounting rate of return, we have payback period, we have payback reciprocal. Accounting rate of return, guys, is based on profits. It is similar to return on investment. Your accounting rate of return will be equal to average profit after tax divided by either average investment or initial investment. What is more appropriate? Average investment. You're not computing return for 1 year, you're computing return for multiple years, guys. That is why you're supposed to divide it by average investment and not by the amount of initial investment. Exam में अगर कुछ भी नहीं दिया बेटा, you're supposed to compute both. You're supposed to divide by average investment as well as initial investment. You do not compute rate of returns separately for each year as such, guys. That is why in the numerator we directly consider average PAT. You can also compute returns for each year separately as such, beta, but in the exam that is not required. Alright, kids. Iska drawback we already know. It does not consider time value of money and it is based on profits. Next, beta, is payback period. Payback period, guys, is the amount of time period that is required to recollect your initial investment. For this, you're supposed to take CFAT. But the drawback of payback period, beta, is that it does not consider time value of money. We are not considering cash flows that arise after the payback period. And also, guys, if you take decisions on the basis of payback period, you will end up accepting shorter duration projects. All right. Payback reciprocal, beta, is the reciprocal of payback period, guys. To compute that, your investment divided by your cash flow, beta, annual cash flow. Payback reciprocal will be an approximation of the actual return that you are generating, provided the duration of a project, beta, is at least twice that of payback period. Or payback, beta, should be less than or equal to half of the overall duration. Only then, beta, then reciprocal of payback, beta, will be an approximation of the return that we are generating. Kahin pe bhi practical question nahi aayega. Just in case they ask this as a 2 marker or a 1 marker, you should know how to define payback reciprocal. Are we clear? Only thing that you should be remembering, beta, is that it is an approximation of actual return. And but that approximation of actual return holds good as such, guys, only if the duration of the project is way too long. Otherwise, it is not closer to actual return. Now, under time adjusted techniques, beta, the first one is NPV. NPV, guys, is the net additional return that you are generating over and above the minimum required rate of return. This net additional return is not being computed in percentage terms, it is being computed in absolute terms. To compute NPV, guys, you write PVCI minus PVCO. Next, beta, is profitability index, which is a relative term. You are trying to compute what is the return that you are generating for every rupee of investment. To compute profitability index, you will write PVCI divided by PVCO. IRR, guys, is the actual return that you are generating on a project in percentage terms. To compute IRR, you will be in search of a discounting rate at which the present value of all the cash inflows is equal to the amount of initial investment. Now, in order to compute IRR, guys, as said, you should ensure that the difference between the lower rate and the higher rate, beta, is only 1%, and at one rate, beta, the value should be more than investment, and the other rate, it should be less than investment. After that, guys, we moved on to modified internal rate of return. MIRR is also the actual return that you're generating on a project, guys. But the problem of IRR, beta, is that whenever you're discounting cash flows at a specific rate as such, guys, you're assuming that reinvestments are also made at the same rate. So when you're computing IRR, you're assuming that all the reinvestments are being made at IRR. And that is not realistic as such, beta. You will not always have investment opportunities that are giving you a higher return. Isliye, beta, to compute modified internal rate of return, we first reinvest all the cash flows at cost of capital. Once we recompute, guys, the accumulated balance, you directly equate that accumulated balance to the amount of initial investment and compute actual return. Accumulated balance is equal to P into 1 plus R whole power n. Usme tumhara R missing hai, beta. That itself becomes MIRR. Do not forget, the only way of computing MIRR is to first reinvest all the cash flows at cost of capital and then arrive at the accumulated balance. So MIRR, beta, is the actual return that you generate when all the cash flows are reinvested at cost of capital. Discounted payback period, beta, is similar to payback period, just that you compare, you arrive at the present value of cash inflows, beta, and then equate it to the amount of your initial investment. So the drawback, beta, of payback period still remains that you're not considering cash flows arising after the payback period, and you will still end up accepting shorter duration projects if you evaluate all projects, beta, based on a single payback period. Are we clear, guys? Now, after discussing all the techniques as such, guys, first thing that you have to remember is, unless otherwise given, your decision should be based on NPV. It should not be based on anything else. If projects do not have same lives, then You have to check whether it's a recurring decision or a non-recurring decision. Nothing is given. Investment in machineries. Will it be recurring or non-recurring? Recurring decision. Machinery is better. After the useful life, obviously you're going to buy machines again. You're not going to shut down your business. So if you're dealing with recurring decision, guys, and the projects do not have same lives, then either you compute EAC or you compute EAB, equated annual cost or equated annual benefit. To compute equated annual cost, you will take present value of total cash outflows beta divided by PVAF. This can be used if and only if revenues under different alternatives are same. If the revenues differ, there is no other alternative. You have to compute NPV. Divide that NPV by present value annuity factor. That will give us equated annual benefit. All right. Next, the other situation that we did beta is capital rationing. I'm telling you, overall projects will be accepted on the basis of NPV. Exception to that first rule beta is when projects do not have the same lives. I cannot directly compare NPV. Second exception beta is situation of capital rationing. Capital rationing beta is where the total amount that is available for investment as such, guys, is limited. If it is limited, guys, you will have to check whether the projects are divisible or indivisible. If the projects are divisible, that is they can be accepted in parts, you pick up a project as such, guys, on the basis of profitability index. You rank all the projects on the basis of PI as such, guys. Whichever project has the highest ranking, that project gets first allocation in the same order. If the projects are indivisible, guys, you cannot rank on the basis of any this thing beta technique. The only option available beta is to check all the possible alternatives and then select the alternative beta that has the highest total NPV. We are not selecting projects on the basis of individual NPV, but our objective is still to ensure that you end up selecting a combination beta where the overall NPV is the highest. Iske alawa beta, we spoke about working capital. I said whenever there is working capital given beta, unless otherwise given, working capital is not going to change. Because working capital is not going to change, guys, you take it as a part of initial investment. Again, you take it as a part of terminal cash inflow. Whether or not it is specified in the question, you're supposed to take it as a part of terminal cash inflow. If working capital changes during the course of the project as such beta, then you take additional investment as and when that cash flow is occurring. Yes. Next, in case they talk about a loss-making entity as such beta in the initial years as such, guys, new project is incurring losses. You will have to check whether it is an existing profit-making company or is it a new company altogether. Unless otherwise given, it will be an existing company. So if it is an existing company beta, losses of the first year can be adjusted against profits of other businesses. Because you can adjust it against profits of other businesses beta, you will immediately get tax savings. In the very first year, guys, you will take tax savings. If it's a new company, you're supposed to carry forward those losses, guys, and adjust it against the subsequent year profits. The only difference beta here is that you will still get tax savings, but those tax savings will arise on a later date. Are we clear? Now, unless otherwise given, we do not follow block of assets method. Which means, guys, if at all you are buying an asset, you're selling an asset, you're supposed to compute what is profit or loss on sale of that asset and then see if there's any tax savings or tax expenditure, guys, on that profit or loss on sale of asset. Usually under SLM method, there will not be any profit or loss on sale of asset because तुम्हारा residual value beta will exactly be equal to book value of the asset. Unless you decide to sell the asset बीच में. जैसे थोड़े questions में beta asset was in use for 2-3 years and then we decide to sell the asset and buy another asset. Situations like this beta market values will not be equal to your book values. Then you may have profit or loss on sale of asset, guys, and then you're supposed to compute tax savings or tax expenditure on such profit or loss. Unless the question says ignore capital gain tax. If the question mentions block of assets method, you will have to normally compute depreciation. Just that beta, you are not going to compute depreciation of the old assets separately, new assets separately. You will have to see what is the net increase in the block. Net increase in the block beta will be based on how much are you paying for the new asset and how much are you getting from the sale of old asset. Cost of new asset minus sale proceeds will be the net increase in block. You directly compute incremental depreciation based on this net increase in block. And there will not be any profit or loss on sale of asset, guys, because under block of assets method, you do not compute profit or loss on sale of individual asset. The block continues. Now, under block of assets also, if they mention that there is only one asset, then it is exactly the same as if there is no block of assets method only. But when you're computing incremental depreciation, even in the first year as such beta, you directly write cost of new asset minus sale value of the old asset. You still compute net increase in block as such beta and then arrive at the amount of incremental depreciation. Are we clear about that, guys? Optimum replacement cycle was also considered, better. Replacement change, guys. If projects have unequal life, there are two ways of presenting the answer. One is equivalent annualized criteria. The other one is replacement chain method. Unless otherwise given, we always follow equivalent approach only. Annualized cost, EAC, EAB. Replacement chain method mein beta, what we do is we purchase the asset multiple times and make the project life same. If the project's lives are same, I can directly take a decision, guys, on the basis of PVC or on the basis of NPV, depending on whether revenues are same or not. Are we clear, guys? Next, if at all they mention, guys, that a particular expenditure is payable in advance, you will have to check whether taxes apply or not. If taxes do not apply, guys, कोई problem ही नहीं है. Directly consider it in the time period in which you are making the payment. If taxes are applicable, guys, I said, though the payment is not being done at the end of the year, guys, tax savings will still you will arise, beta, only at the end of the year. इसीलिए क्या करोगे, बेटा? First, for computation of profit and tax, you will consider the expenditure in the year to which it relates to, not when you paid it. ठीक है? जैसे if it is first year का, you will deduct it from your first year profits. You compute the correct amount of taxes and then you add back that expenditure. Once you add it back, guys, you take it in the year in which it has been paid. Are we clear? Do not forget the point of advance expenses paid in advance, guys. और क्या था बेटा? Optimum replacement cycle भी किए थे, guys. I said in case the existing asset as such, guys, have you have an option of using it for a couple of years as such, guys, then you will have to evaluate what is the equated annual cost of using the asset as such, guys, for 1 year, 2 years, 3 years, जो भी है, and compare it as such, guys, with the equated annual cost of the new asset. In case the equated annual cost of the new asset is less, you directly select that better. Otherwise, if the existing asset has a lower cost, you use the existing asset for a couple of years and then you shift to the new asset. और क्या बोले थे बेटा? हो गया. हाँ नहीं multiple, हाँ multiple IRR, guys. There's multiple IRR. हो गया. Adjusted present value beta was also covered, guys. Adjusted present value mein you divide your overall NPV into two parts, guys. One is base case NPV, the other one is whatever are the cash flows related to capital structure. For computation of base case NPV, you directly consider your operating cash flows as such, guys, and you compare it with the amount of initial investment. Once that is done as such, guys, any cash flow that is arising on account of capital structure will be considered in the second component. When I say any cash flow, beta, you're supposed to take issue cost, you're supposed to take tax savings on issue cost, you're supposed to take tax savings on interest, but not interest itself. We are still computing NPV from the viewpoint of the entire firm. We're supposed to take tax savings. You're not supposed to consider interest as outflow. यहाँ पे बेटा I said the concept is similar to Modi-Gilani Miller approach. It's like valuing a levered firm after valuing an unlevered firm. Are we clear, guys? बस. हाँ? हो गया. बीच में बोल दिया बेटा मैं कि normally decisions are taken on the basis of NPV except two scenarios. One is projects with unequal lives, the other one is capital rationing. Baki any question beta if they do not specify anything, you're always supposed to take a decision only on the basis of NPV. Clear beta? Chalo guys, all right. नहीं हुआ. Online students, 1 second beta. Thema bhi beta. Online students, recording pause करके start किया बेटा. So all right, guys, quick beta. First one, ratio analysis. This entire chapter, guys, is for the purpose of financial statement analysis. If someone wants to analyze the financial strength and weakness of an entity as such, beta, that is done with the help of ratios. There are other ways also, guys, of analyzing the strength and weakness of an organization. One way of doing that, beta, is ratio analysis. For this purpose, guys, I told you, beta, that the overall ratios of an organization, guys, are segregated into 4 categories. The first category deals with short-term solvency or liquidity ratios. The second category is long-term solvency, guys, or leverage ratios. The third category as such, beta, is activity ratios or performance ratios or efficiency ratios, turnover ratios. The last category, beta, is profitability ratios. The first category, beta, liquidity ratios, deals with the ability of a company, beta, to pay off their liabilities over the next 1 year as and when they fall due, also known as short-term solvency. Do we have sufficient amount of funds available or not to clear off our liabilities? For this beta, there are three major ratios. The first one is current ratio. The second one is quick ratio, also known as acid test ratio or liquid ratio. The third one is cash ratio. Current ratio, guys, is computed as current assets divided by current liabilities. What are the total available current assets that can be used to clear off your current liabilities? An ideal current ratio, guys, is 2:1, though it differs, guys, from one company to another company. Current liabilities, guys, will always be less than current assets, because I also spoke about the concept of permanent working capital and temporary working capital. Working capital is current assets minus current liabilities. A part of your working capital is always permanent. That means it is going to remain in your organization forever, guys. The excess requirement that keeps fluctuating as such beta is temporary working capital. It is better to fund your permanent working capital through long-term sources, long-term permanent working capital. Temporary working capital, it is better to fund through short-term sources. Because a part of your working capital is being funded out of long-term sources, guys, that is why we say that an ideal current ratio is 2:1. Not every current asset beta should be funded out of current liabilities. It should be funded partially out of long-term liabilities. Are we clear? As a matter of funding rule as such, guys, your average age of receivables should match with the average age of payables. You should be able to match your receipts with payments. If you're not able to match your receipts with payments as such, guys, there will come a situation better wherein we are not able to pay our debts on a timely basis. If I have a payable in 1 year, I have to also ensure better that I have some receivable in a span of 1 year. If you know that you're going for further studies in a span of 1 year, shouldn't you be saving money better to ensure that you have funds available at that point? So that is matching average age of receivables with average age of payables. Banking की industry में बेटा इसको बोलते हैं ALM, Asset Liability Management. Traditional hedging technique used by banks is ALM. Anyways, guys, back to this. Liquidity ratio. First one beta is current ratio, which is current assets by current liabilities. The next one beta is quick ratio. Under quick ratio, guys, we only take near cash assets. We do not take all the current assets, guys, to consider the repayment capability of current liabilities. Now, under near cash assets beta, we do not take inventory, we do not take prepaid expenses. Inventory cannot be realized in cash as and when you want it. Inventory can only be sold in the ordinary course of business. That is why it is not considered as a near cash asset. Prepaid expenses ke against, you do not have a right to receive cash, you only have a right to receive service. So both of them should be excluded from current assets to arrive at quick assets. Loans and advances is still considered as a quick asset. Someone had a doubt here. But because any receivable, guys, if you have a right to receive a fixed amount of money, any receivable can be sold and you can fetch money against it. The only amount that you're going to lose is time value component, nothing else. That is why loans and advances, trade receivables are also considered as near cash assets, quick assets. You're only supposed to reduce inventory and prepaid expenses. The third ratio beta is absolute liquidity, which is cash ratio. Under absolute liquidity, guys, you do not consider all near cash assets, you take only cash assets. Cash and other marketable securities which can be converted into cash on one click of a button. Are we clear, guys? So the formula beta will be cash and marketable securities divided by the amount of current liabilities. Then beta we spoke about interval measure. यहाँ पे beta working capital में they will give us the amount of working capital, they will give us current ratio, quick ratio. You should know how to arrive at the amount of current asset, you should know how to arrive at the amount of current liability. CA minus CL is your working capital, current ratio is CA divided by CL. Are we clear about this? Next beta is interval measure. Interval measure mein beta I said how long will you be able to meet your expenses, survive, guys, with a given amount of assets. So under this beta you take your quick assets divided by average daily operating expenses. इसका और एक modified form है wherein we take only cash and marketable securities and divided by average daily operating expenses. But अपने लिए syllabus में I told you it is quick assets divided by average daily operating expenses. Are we clear about this? After this beta we moved on to leverage ratios or long-term solvency that talks about the survival of an organization over a longer period. As long as you do not have any amount of debt in your business beta, the firm is here to stay for a very long period. Survival becomes a question mark if and only if the firm has been borrowing excessively. Only then beta there will be a chance of liquidation of the entity. Of course, business hi khatam ho raha hai beta, product does not have a market, then there's nothing that we can do. But on account of capital structure as such, guys, solvency would be a question mark if and only if you have huge amount of debt. Are we clear about this? So this long-term solvency, guys, or leverage ratios, we further segregated beta into two categories called as capital structure beta and coverage ratios. So here beta, I told you that you should know what is the meaning of the word shareholders funds. If I use the word shareholders funds, it includes equity share capital, preference share capital, reserves and surplus. If there are any fictitious assets or accumulated losses, you're supposed to reduce it. The word capital employed, guys, includes all the long-term sources of capital, only long-term sources. You do not include any short-term debt or current liabilities. The word proprietary funds beta is exactly the same as shareholders funds. The word equity, guys, can either mean shareholders funds or can mean only owners equity, depending on the ratio. The word equity beta sometimes would mean all shareholders funds. Sometimes the word equity beta would mean only equity share capital and reserves and surplus. So the first ratio beta that we did here, guys, was equity ratio. Equity ratio here includes only equity shareholder funds. It does not include preference share capital. Under equity ratio beta, we are taking the ratio of shareholders equity, guys, to shareholders equity beta to net assets. 1 second beta. You take shareholders equity beta, divide that by the amount of net assets employed. Are we clear? We're basically computing, guys, what percentage of your total capital is coming in the form of equity. Are we clear? जैसे capital structure ratio में जो अपन करे थे बेटा, अगर equity is 10%, preference share capital is 40%, debt is 50%, equity ratio is automatically 10%. That's the proportion of equity in the overall capital employed of the firm. Next beta is debt to equity ratio. Unless otherwise given, the word debt to equity ratio would be based on total debt and not just long-term debt. And the word equity will include preference share capital. So you write total debt divided by all shareholders funds. Total equity that includes preference share capital. Debt to total assets बेटा कुछ पढ़ाने की जरूरत नहीं है, नेम ही बोलता है, it is total debt divided by total assets. Capital gearing ratio, guys, is a modification of debt equity ratio. Instead of taking only debt in the numerator, guys, you take all capitals with fixed obligations. But the word capital means you're only supposed to take long-term capital, you're not supposed to take short-term capital. So you'll write long-term debt plus the amount of preference share capital divided by equity share capital plus reserves and surplus. So proud of you guys. Minus accumulated losses. Proprietary ratio, guys, is proprietary funds as a percentage of your total assets. Proprietary ratio we have used in a lot of questions, guys. But whichever question had proprietary ratio, therein we took an assumption that net long-term debt is 0. That is where beta you'll be able to write shareholders funds is equal to fixed assets plus working capital. They will tell us that fixed assets is some proportion of your proprietors funds. So the balance proportion beta will be working capital. We use that relation to compute everything. Yaad hai? Next beta is coverage ratios under long-term solvency. Coverage ratios basically talk about beta how well are you covered for a specific expenditure. Okay? Now, if it is for revenue expenditure, I always said beta you should consider what is the amount of profit available to meet that expenditure in the numerator divided by the expenditure itself. If it is for capital repayment, guys, instead of considering profits, we consider cash flow. So for interest coverage ratio, guys, we write EBIT by interest because interest is paid out of EBIT. For preference dividend coverage ratio, we write EAT divided by preference dividend because preference dividend is paid out of profit after taxes. For equity dividend coverage ratio, better earnings attributable to equity shareholders divided by the amount of equity dividend. For debt service coverage ratio, which talks about repayment of both principal as well as payment of interest, you should take cash flow in the numerator, but that cash flow beta should be from operations. I told you, you do not consider cash flows on account of sale of asset and everything. That is why we write PAT, add back interest, add back depreciation, non-operating adjustments, adjust karna, and then divided by interest plus principal payment. There was not even a single question beta in which we have used debt service coverage ratio. वो पूछना बंद कर चुका है, but it is still important. You should still know what's the formula for debt service coverage ratio. Next beta we did fixed charge coverage ratio. I said this is YR, but फिर भी guys, it is EBIT plus depreciation divided by interest plus principal. After this beta we moved on to the third category of ratios, that is activity or performance or efficiency ratios, turnover ratios. This is how well are you utilizing your assets in generating revenues for the firm. Now, the first one here beta was any turnover ratio, guys, usually it is sales in the numerator divided by the corresponding thing. So if it is total asset turnover ratio, it is sales divided by total assets. If it is Fixed assets turnover ratio, it is sales divided by fixed assets. Capital turnover ratio, but as sales divided by capital employed. Working capital turnover ratio will be sales divided by working capital. Now, apart from this, guys, for current assets, better we have inventory turnover ratio, debtors turnover ratio, and creditors turnover ratio. Inventory turnover ratio, better you take COGS divided by inventory, average inventory. If details of average inventory are not available, we take closing inventory. The turnover ratios, guys, are for a period. They're not as on a date. This is why averages are considered. इसके पहले अभी तक जो भी liquidity and long term solvency करे बेटा, they were never for a period बेटा, they were all as on a date. So there you will not have the question of closing, opening and all of that, guys. Are we clear about this? Now inventory turnover ratio is COGS divided by average inventory. Debtors turnover ratio, because debtors are reported at sales value, in the numerator you have sales, so that is credit sales divided by average debtors. Creditors turnover ratio will be credit purchases divided by average creditors. What is important to note better is if there are bills receivable, bills payable, they are included in total receivable and total payable. We did one question in which we had bills receivable and bills payable. So denominator mein beta, it is not just average debtors, it is total receivable. Denominator mein it should be total payable. If they ask us to compute debtors and creditors as such, guys, you're supposed to remove bills receivable and bills payable, and the balance beta will be debtors and creditors. If they ask us velocity, it is holding period or collection period or payment period. That will be 365 divided by your turnover ratio. After that, beta, profitability ratios, 4 categories. We have profitability ratios based on sales, related to investments, owner's viewpoint and finance, that is markets. The first one, beta, based on sales, you should know what is gross profit, what is operating profit, what is net profit. From sales, if you remove COGS, beta, you arrive at cost of goods sold. From cost of goods sold, if you remove operating expenses, you arrive at operating profit, which is also EBIT. Unless otherwise given, the only non-operating item that you have, beta, is तुम्हारा zero है भाई. The only non-operating item, beta, that we have is interest. So you arrive at EBIT. From EBIT, beta, you deduct interest to arrive at EBT. From EBT, you deduct taxes to arrive at EAT. ठीक है? So here, guys, EAT is your net profit. So in case they ask us net profit ratio, the answer is EAT by sales. In case they ask us gross profit ratio, it is gross profit by sales. Operating profit ratio is operating profit by sales. What is important is operating expense ratio and operating ratio. Operating expense ratio does not include COGS. You will only take admin expenses and selling and distribution expenses. Divide that by the amount of sales. Operating ratio, on the other hand, beta, includes all COGS, admin expenses, selling and distribution expenses. This is railways ka operating ratio, but is about 99%. That means the profit that is left as such, guys, before payment of interest also is only 1% of the amount of revenues. I'm not sure if you were aware of that. Operating ratio of railways is always in the range of 98 to 101%. था तुम्हारे पास ये? Railways का बेटा is 99.5 अभी हाँ. Railways का हमेशा ज़्यादा बेटा, because railways is more of a social project as such, guys. It's not always to be viewed from the perspective of economic benefits. The social impact as such, guys, is more important. Same thing with metro is also better. It's not just financial parameters, it is also about the other positive aspects as such, guys. Look at the amount of time that people save as such, better. Look at the reduction in pollution as such, guys. All those factors should be considered before we jump to conclusions only based on financial factors. Anyways, are we clear about this better? Next is profitability ratio based on investments, guys. I said what comes in the numerator will depend on what is coming in the denominator. If you have all the providers of capital in the denominator, guys, then you should also have return available to all the providers of capital. If you have only shareholders in the denominator, then you will have only returns available to shareholders. If you only have equity in the denominator, you should have only return available to equity shareholders. So if it is return on investment as such, guys, it is EBIT or EBIT into 1 minus tax rate, whether it is pre-tax or post-tax, divided by capital employed. If it is return on net worth, the word net worth means all shareholders' funds. This can never be pre-tax, it is always post-tax. You will write profit after tax divided by shareholders' funds. If it is return on equity, guys, it is earnings attributable to equity shareholders divided by the amount of equity shareholders funds. Return on net assets, return on total assets, guys, you will still have EBIT in the numerator or EBIT into 1 minus tax rate. Let it be total assets, let it be net assets, because we are basically considering all the sources of capital. Are we clear, guys? एक आधे question में बेटा for return on total assets we had to take profit after tax because there was no detail of interest, no details of taxes. We did not have an option. We had to equate that to earnings after tax. So formulas can change depending on the information given in the question, guys. After that, beta, we moved on to ratios, guys. From the viewpoint of owners, there was nothing better there. We only computed earnings per share. अच्छा, DuPont analysis क्या पहले एक सेकंड बेटा, कहाँ गया नहीं मालूम है. हाँ जा रहा हूँ एक सेकंड. We've computed return on equity, guys, using DuPont analysis, better. Under DuPont analysis, guys, I told you instead of directly computing return on equity, you segregate that into 3 components. The first one is net profit margin. The second one is asset turn. The second one is asset turnover ratio. The third one is equity multiplier. Net profit margin is what is the amount of profit that you're generating as a percentage of sales. Asset turnover ratio, how well are you utilizing your assets to generate your sales. Equity multiplier, what is the total asset base that you're creating as such beta with a given amount of equity. ठीक है बेटा, तनु थोड़ा साइड में. हाँ, with a given amount of equity, guys, is what comes under beta equity multiplier. You multiply all the 3 components, you will get your return on equity. Next, beta, profitability ratios from the viewpoint of owners. We have only EPS and dividend payout ratio. EPS is earnings attributable to equity shareholders divided by number of equity shares. Dividend payout ratio is dividend per share divided by earnings per share. Next, beta, is profitability ratios. अब तुम लोग abbreviation सुनते तो वो expression रहता मेरा. हाँ. Profitability ratios, guys, related to markets के साथ बेटा, we have P ratio, which is MPS divided by EPS. P ratio is relative. This valuation measure or absolute valuation measure? Relative. There's no way better that you do anything with P ratio. You only compare it as such, guys, with other industries. I told you large cap industries better will have a P ratio of about 27-28 times as such, guys. Overall Nifty का अगर P ratio 30 के आसपास आ रहा है, we say that it is overvalued. So either the earnings should increase or Nifty should crash. Only option है. Then small cap industries as such better can have a P ratio of 60-70 times because they have a higher growth potential. If the cost of equity is higher such, guys, then your P ratio should be less. Next beta is dividend rate, dividend yield, earnings yield. Dividend rate is such beta is dividend as a percentage of market face value. Dividend yield is dividend as a percentage of market price. As an investor, are you bothered about dividend rate or dividend yield? Yield. What is important to you beta is the amount of dividend that you're making as a percentage of market price. Earnings yield is same beta, earnings per share divided by market price per share. Book value per share beta is what are the total assets available to equity shareholders based on books on a per share basis. So that will be equity share capital plus reserves and surplus minus accumulated losses and divide that by the number of equity shares. Once we compute book value per share, guys, there's an important relative ratio again, which is PB ratio, price to book ratio or market value to book value ratio. That PB ratio as such, guys, is dividing market price per share divided by book value per share. जैसे कल Dixon Technologies का बताया था बट abnormally high as such, guys, only because the company has a huge growth potential. ठीक है. Next beta is Q ratio. कभी आया नहीं एग्जाम में, but it is still given in your materials. It is the market value of all the sources of capital that you have beta divided by the replacement cost of assets. So basically we are comparing, if you were to set up the business today, what is the amount that you're going to incur to buy those assets? In relation to that, what is the market value of your business? But all the sources of capital, the ratio that we're computing using Q ratio. So theoretically बोलते, if Q ratio is more than 1, the company is overvalued, but real life में बेटा Q ratio will definitely be more than 1. Book value of assets, replacement cost of assets will be less better. Market value of equities will be substantially high. Are we clear? I also told you but a couple of days back that a modification of P ratio is PEG ratio. Comparing P ratio with the growth of an entity to know better whether the P ratio is justified or not. Are we clear about this? Any doubt in this, kids? समझ में आ गया? और कुछ revision बाकी था? Capital? अब आने तो मालूम नहीं हुआ capital structure. Let's quickly revise dividend theories. But first, I told you that dividend decisions as such, guys, deals with the fact whether a company has to declare dividend or not. If yes, what is the amount of dividend that is to be declared by a company? There are 3 forms of dividend, guys, that are covered, guys, under this chapter. I told you the first one beta is in the form of cash dividend. The second one is in the form of stock repurchase, guys. The third one is in the form of bonus shares. When you say cash dividend, guys, it involves payment of dividend in the form of cash to the shareholders of the entity. In reality, that is the only form of dividend beta that exists. There is no other form of dividend. Stock repurchase is another way of distributing cash to the shareholders of the entity, guys, by buying back the shares. In case a company has surplus funds which does not need for the purpose of reinvestment, instead of declaring dividend, it can always buy back its own shares from the market. The third one is such beta is bonus shares, where shares are issued without any consideration, guys, to the equity shareholders of the entity. The objective behind issuing bonus shares as such beta is to ensure that we reduce the market price in case the share price has increased a lot. Now you will be able to issue bonus shares, guys, only if your existing shares are fully paid up, guys, and bonus shares can be issued only in the form of fully paid up shares. It should be authorized by your articles of association approved by the shareholders. वो जो भी conditions है बेटा, you can only use CRR, guys, securities premium and free reserves for the purpose of issuing bonus shares. Now the primary factor beta that drives your dividend decisions is the reinvestment opportunity. In case a firm has reinvestment opportunity as such beta, then and the return that is being generated on that is expected to be generated is greater than the cost of capital, a firm would want to reinvest all of their earnings and declare a very low dividend. Right, that's the most important factor. I said other considerations but include your liquidity position, include the tax consideration, guys, and then capital structure decision. After that beta, we moved on to the concept of dividend theories. We divide the overall theories into two categories beta, irrelevant theories and relevant theories. Irrelevant theories basically tell us, guys, that dividends are not relevant to determine the market value of the entity. Relevant theories के हिसाब से बेटा dividends have an impact as such, guys, on the market value of the entity. Now there's only one irrelevant theory that we have beta, and that is approach, guys. As per Modi-Gilani Miller approach is such beta, no matter what is the amount of dividend, the overall value of the company is going to remain constant. Now this is possible, guys, only because of the assumptions of approach. The first assumption beta is that R is constant, K is constant. A firm will be reinvesting as such, guys, only either out of retained earnings, guys, or out of issue of equity shares. We assume that there is no debt. We assume that taxes are not applicable. We also assume beta that R, that is a return that we generate, guys, is equal to your cost of equity, cost of capital, guys. So as per Modi-Gilani Miller beta, we write P naught is equal to D1 plus P1 divided by 1 plus K. Under Modi-Gilani Miller approach, we are not computing P naught, guys. We are only computing P1 using P naught and D1. Once we arrive at the amount of P1, guys, under Modi-Gilani Miller approach, I told you, you should know what is the amount of earnings that you are retaining. And then what is the additional amount of funds that you're supposed to raise beta by issue of equity shares. Those equity shares as such, guys, combined with the existing equity shares multiplied by price will result in same market value with or without dividend. In case they ask us to prove that the value of the firm remains same, you are also supposed to arrive at present value. For that, you will deduct the entire amount of investment, add the amount of earnings from the market value after a year, and then discount it. That will become value today beta, and that will remain same. Are we clear about this? The next theory as such beta that we moved on to was Walter's model. As per Walter, guys, again, all the amount of investments will only be made out of retained earnings, guys. We are not making any amount of investments out of fresh issue of equity shares also. Now, your earnings will remain constant as per Walter, dividends will remain constant, R will remain constant, KE will remain constant. But Walter beta considers all the three possibilities of R and KE. R can either be greater than KE, can be less than KE, or it can be equal to KE. So we have a constant firm, we have a growth firm, we have a declining firm. No. As per Walter, guys, the price of an equity share is segregated into two components. The first one is present value of dividends. The second one beta is present value of earnings on retained earnings. The only problem with this formula beta is that it does not consider the compounding impact of earnings on retained earnings. So we write P is equal to D by KE plus R by KE into E minus D divided by KE. This is how you arrive at price of an equity share using Walter's model. Now, if it is a growth firm as such, guys, a company should be paying out 0%. That will result in the maximum value per share. If it's a declining firm as such, guys, a company should pay out 100%. If it's a constant firm, any payout ratio is fine. The value of the share is going to remain constant. If they ask us the correlation between dividend per share and market price per share, guys, for a growth firm as such, guys, the relation is negative. For a declining firm, the relation is positive. For a constant firm, the relation is 0. No correlation at all as such beta. Now, In case they ask us to compute limiting value of the shares as such guys under Walter's model, we're supposed to compute minimum price and maximum price. Also, in case cost of equity is not given, but we equate it to 1 divided by PE ratio. If the requirement itself is to compute cost of equity under Walter's model as such guys, then you compute price as such guys as per PE ratio and then equate it to Walter's model and then arrive at cost of equity. We did that only in one question, that is not likely to come. But however, if the requirement is to compute price as per Walter's model as such, then there's no other alternative. You will have to assume that cost of equity is equal to 1 divided by PE ratio. After that, beta, we moved on to Gordon's model under relevant theory. Gordon's model is nothing but, guys, a modification of dividend discount model. Just that the growth rate, guys, here depends on retention ratio and return on equity. You write G beta is equal to B into R. For both Walter's model and Gordon's model, unless otherwise given, the dividends given beta will be for year 1. You are not supposed to adjust growth rate to dividends unless it is clearly given that it is dividend distributed or already paid. Are we clear, guys? Now, Gordon के हिसाब से बेटा price of an equity share is equal to D1 divided by KE minus B into R, where B into R is your growth rate. Again, there are 3 categories of firms, guys. You have growth firm, constant firm, and declining firm. यहाँ पे बेटा the word optimum payout ratio is generally not used. However, if they ask us to arrive at optimum payout ratio for a growth firm, you say that the answer is 0%, but also write a comment that the value of the share cannot be computed, guys, using Gordon's model at 0 payout ratio. Are we clear, guys? Now, under dividend discount model, guys, if they ask us to arrive at price of an equity share, you're supposed to check whether dividends are constant or whether dividends are growing at a constant rate. If dividends are constant, guys, formula yahin pe, price will be equal to D by K. If dividends are increasing at a constant rate right from year 1, you write price is equal to D1 by K minus G. If the growth rate is variable, guys, that means the growth rate is not constant. You can use a formula of constant growth perpetuity, guys, only when the growth rate stabilizes. So in case they tell us that the growth rate is different for first 10 years and then the growth rate stabilizes after that, you're supposed to compute P10 using constant growth perpetuity and then discount the first 10-year dividends and P10 to arrive at P0. In case they tell us that the growth rate stabilizes after 4 years, you compute P4 and discount first 4-year dividends and P4 to arrive at P0. This is what you will do better to arrive at the value of equity share. इसके अलावा बेटा, apart from this, we also did Graham and Dodd model, guys, and then we did Linter's model. I told you Graham and Dodd model actually is not covered as a part of your syllabus, but then the point there is important. Graham and Dodd बोलता है बेटा that the value, shareholders place a higher importance, guys, on realized earnings than on unrealized earnings. That is why when you value an equity share, you should be giving a higher importance to dividends than to the amount of earnings. The price of an equity share beta will be equal to M into D plus E by 3. When you're writing D plus E by 3 beta, we are giving only 1/3 weightage to earnings as that of dividend. Alright. Linter model के हिसाब से बेटा there should be stability in the amount of dividend year after year. For that to happen, guys, I spoke about dividend policies first. I said there can be a constant dividend policy where the amount of dividend paid remains constant year after year. There can be constant payout ratio where the percentage of earnings that is being paid out as dividend beta will remain constant. There can be residual dividend policy wherein whatever is left after providing for reinvestments, guys, will be distributed as dividend. Constant payout ratio policy ka drawback beta is that as the earnings keep fluctuating, your dividends also will fluctuate. This is where Linter comes into picture. Linter says we can have a payout ratio, but that should be target payout ratio that you're going to achieve over a multiple year period. So in order to arrive at current year dividend, you will have to take an average of current year earnings and the previous year dividend. Current year earnings को target payout ratio से multiply करना mandatory है because we never declared the entire amount of earnings as dividend. What you do beta is current year earnings multiplied by target payout ratio multiplied by adjustment rate, speed of adjustment, plus last year dividend into 1 minus adjustment rate. This adjustment rate as such, guys, will depend on the stability of earnings. If the earnings are more stable, guys, the rate at which you will be adjusting your dividends to current year earnings would be very high and the weights are going to be closer to 1. If the earnings are way too volatile as such, the value of W will be less than 0.5, so that you give a higher importance to last year's dividend and a lesser importance to the current year earnings. This was under Linter's model. इसके अलावा बेटा this chapter also talks about stock buyback and talks about book value per share. I told you about a stock buyback इसलिए करते हैं if a company is not very sure about the stability of earnings and they still have huge cash balances, instead of distributing them as dividend, it is always better to buy back equity shares. When you buy back equity shares, the other important thing better is that it reduces the total shares held by the public and in turn increases the percentage holding of the promoters. The earnings will get distributed among lesser number of shares, thereby resulting in a higher EPS. The net assets of the company as such better will get distributed among lesser number of shareholders. That will also increase the overall market value of the company, market value per share guys of the remaining shareholders. Are we clear? Book value per share का मतलब होता है बेटा whatever is the net assets as per books of accounts attributable to equity shareholders divided by the total number of equity shares. For this, you can also write equity share capital plus reserves and surplus minus accumulated losses divided by the number of equity shares. You divide this by the number of this thing, but you get book value per share. Last के दो questions इस पे थे बेटा. They asked us to compute book value per share, and they also asked us what was that? Yeah, one more concept beta that we did here was cum dividend and ex dividend. Any dividend valuation model as such beta will always result in an ex dividend price. If you add the amount of dividend to that beta, it will become cum dividend price. Whenever a company is declaring dividend guys, post the record date as such guys, the value of the equity share is going to reduce exactly by the amount of dividend. So in case they tell us that the value of the share is 200 rupees and the company has declared a dividend of 20 rupees, after dividend the price should be 180. There was this question in which we had to make reinvestments. I said reinvestments will be made at 180, not at 200. 50, 10, 40 tha. In my example, 220 and 180. Anything else, beta, that was there in dividend? Limiting value of shares, beta, जब तुम लोग सो रहे थे तब पढ़ा दिया था. I also spoke about the types of financing decisions, guys. Starting में, the three types of financing decisions, guys. Financing, investment and dividend. Investing decisions deals with application of funds. Financing decisions deals with sourcing of funds. Dividend decisions deals with distribution of funds. Are the three interrelated? The answer is yes. If a company has higher amount of investments to be made as such guys and they already have a capital structure in mind, that is definitely going to impact the amount of dividends that you're going to declare. We have learned in pecking order theory also that the first preference is always given to retained earnings guys. After that as such beta, external funds. So इसीलिए yeah, the three decisions guys are interrelated. ये theory में आ सकता है guys. इसके अलावा there are other theory parts but are here practical considerations and what are the determinants पूरा पढ़ा चुका हूँ material में देखना अभी नहीं बाद में. Significance of dividend policy में वही दिया हो बेटा. That dividend policy will affect your long term financing decision and it will also is a wealth maximization decision. You would want to retain only if R is greater than KE, only then it is going to maximize wealth. You will not want to retain if R is less than KE, because if you do that as beta, you're going to destroy the wealth of the shareholders. So dividend decisions ka importance here is it's going to affect your financing decision as well as your wealth maximization. Are we clear about this? All right, beta.